Well, hi everybody, my name's Rick Spooner. I'm the Chief Market Analyst with CMC Markets in Sydney. Most people who've done any reading on trading will be aware that good risk management is fundamental, or it's a real key to success as a trader. And most good risk management strategies involve stop losses. Today's webinar aims at helping people go to the next stage, and we look at some strategies for actually using stop losses and building them into trading strategies. What I'm going to look at today is trailing stop losses. I'm going to cover briefly what they are exactly and how they work. I'm going to look at some of the advantages and disadvantages of trailing stop losses compared to fixed price stop losses, and finally just cover off on a few different strategies for using trailing stop losses. Before I get going though, I just need to pause to provide you with an opportunity to read our disclaimer. Alright, now just to cover briefly what stop loss orders are. Today I'm going to be looking at stop loss orders as opposed to stop entry orders. So a stop loss order is used to close, sell order is used to close an existing bought position. So by definition, a stop loss sell order can only be placed below the current market, and that means that when you first enter the market with a buy order, the stop loss order must by definition be placed at a level that's going to result in a loss. It must be a worse or lower price than you've entered the market. As time goes by though, it's always open to you to move the stop loss order as the market moves in your favour, or if it moves in your favour and becomes profitable, and in those circumstances a stop order might actually close you out at a profit despite the name of the order as a stop loss order. So here's a typical example. Here's a well-defined trend, a market that's been bouncing off both a well-established trend line and the 50-day moving average, which is the blue average moving line, average line shown on the chart here. So here typically a trader may have entered the market perhaps after the market had moved well away from this support zone again with a buy order, and at that stage placed their stop loss down below the trend line and the moving average, on the basis that if price fell below that level, that would be an indication of failure and a price at which you might want to be out of the market. Something to be aware of with stop loss orders though is that you're not guaranteed to get out at the level you set the stop at. All the level that you set the stop at is a trigger to then execute a market order, and there might be times when the best available price at which a market order can be placed will be quite a bit worse than your stop loss trigger. This is quite a common occurrence in the stock market, firstly because of course it closes overnight and the market might open at a significantly lower level next morning, and also because stocks are often put into a trading halt while there's some major news event, such as, for example, a release of a downward revision in profit guidance, which will mean that the price will go straight to a new lower price and might well gap below your stop trigger order. So certainly possible, and something to be aware of, that setting a stop loss order does not mean that you'll be taken out at that price. So a stop loss buy order, everything is just in reverse. Stop loss buy order is used when your position is short, when you open with a selling position to take advantage of a market falling. Then by definition, when you first place the order, it must be above the current market price, and that means that to begin with it must be set at a level which will result in a loss to you, because you would be, if it's triggered, you will be buying at a price that's worse than the level that you've sold at. So a trailing stop loss order is one where the price is automatically adjusted each time the market moves in your favour. So if you buy the market and set a stop loss sell order, then every time the market rises to a new level, the stop loss will be automatically dragged up. And so the trailing stop is set with a fixed trail or a fixed amount, so that it's always a certain fixed amount behind the highest price. Something to be aware of with trailing stops, though, is that they never move backwards. So even though they're dragged up if the market's moving in favour of a long or bought position, once the market starts to fall, the stop loss will stay where it was, and the market will fall back towards it, and on some occasions, of course, it will fall right back to the stop loss and trigger the order at that price. All right, well, let's take a bit of a look at how trailing stop losses work in practice on the platform. I'm going to have a look at the Aussie US dollar, so let me select the chart here. Just expand that out a bit so it all is a bit easier to see. So I've noticed this bit of a trend channel here. There's a bit of a falling or standing under a falling knife trade, but anyway, to illustrate the purpose, we seem to be bouncing off this bottom support line of this potential channel. So the idea here might be to buy. So let's select our buy ticket. We'll put in any amount, but say $100,000. And what we now want to do, if we're going to buy it at market, we now want to put a stop loss in, because we always have a stop loss every time we enter the position with our prudent risk management philosophy. So now when you open up the ticket here, you see you have a choice between regular, which is a fixed stop loss, or trailing. So we're going to select trailing here, and then we can select either the number of points we want the trail to stop by, or if we prefer, the amount, $200 and so forth. But in this case, I'm going to select the number of points, and I'm going to say, let's say 100 pips. And I'll enter that, and that's going to tell me that that's going to result in a loss if my stop loss is hit of $1,092. So now I simply confirm that order, and the order is placed, and as you can see now, the chart will show me that where I bought and where my stop loss is placed, which in this case is just under the channel support. So what's going to happen now is that if the market continues to rise, then every time it makes a higher price, this stop will be trailed up by and remain 100 pips below the highest price. But if price starts to fall back towards the stop, then the stop will stay fixed and until such time as it's actually triggered by price falling to the stop trigger level. Now, a couple of other things that might be helpful with stop losses generally is that there are quite a few options in the platform in terms of setting your preferences for how you might like to handle stop losses in a standard way. And that can be done up in this little icon in the top right hand corner of the chart on the toolbar up there, user preferences. I click on that. If I click on that, one of the alternatives I have is order settings, and there are a number of things I can do with stop losses if I choose to increase my flexibility and time management. Our next-gen platform gives you the flexibility to choose whether you want your stop triggered by the bid price or the price at which you can sell, in this case for the Aussie, 0.91056, or do you want it triggered by the offer price, the price at which you buy, in this case 0.91067, or alternatively you can elect to have the stop triggered by the mid price between the bid and the offer. To do this, go to the order settings preferences and choose to enable custom stop order triggering. Click the accept, and you can then choose an alternative of either a standard, a mid or a cross price setting. Now the standard involves having your stop triggered by the first price that arrives at your stop trigger level. That means, for example, if you're long and you have a sell stop loss on, then the stop will be triggered by the bid price, or the price at which you can sell, the lowest of the three prices hitting your level. The mid price obviously is the halfway point between the bid and the offer, and the crossing the spread alternative involves waiting for the last price, or in the case of a sell price order, the offer price or the highest of the three prices hitting your trigger level. Now what's involved here? Well, there's no right or wrong in this decision. There's no best or worst. As with most things in trading, it involves a trade-off between various considerations. If you use the standard setting, then you're taking a conservative approach to your stop going off. It'll be hit by the first price to reach there, and it means that if the price is in the general range of where you want your stop to go off, you'll have the greatest certainty that it will be triggered and will take you out of the market. A lot of traders, though, trade on a technical basis, and those kind of traders often prefer to set their stop at a level where the market has actually traded. And in some cases, particularly thinly traded markets, like some of the smaller stocks, or thinly traded currencies, particularly say early Saturday morning when the markets are winding down, early Saturday morning Australian time or Friday night in Northern Hemisphere time, the spreads can be quite wide. And one consideration with using the standard setting is that your stop might be triggered by this bid price hitting that level, but the market won't actually have traded there. If you go the other way and use the spread alternative and wait, in the case of a buy stop, for the sell price to actually get down to that level, then you'll have a significant amount of certainty that when your stop is triggered, the price and market will actually have traded there, so you know that the market itself will have triggered the level you want to trade at. The difficulty there, of course, or the trade-off, is that in markets with wide spreads, or where spreads widen out, then the actual traded price might be quite a long way away and quite a long way below the sort of level that you did want to have your stop triggered at. But by giving the trader the flexibility as to which alternative to choose here, the platform allows you to choose the best alternative on balance for you, and that will involve considerations of what sort of instruments are you trading. Are you trading instruments like smaller stocks with wide spreads, or only the big FX markets that have relatively tight spreads? Are you a short-term trader where your overall results are very price sensitive and an extra couple of points here or there makes a difference? Or are you a long-term trader where this is a relatively minor consideration if you're the sort of trader who's trading positions that you may be in for days, weeks or months? And of course, it's a matter of personal preference. But whichever way you choose to go, is simply a matter of clicking the customer order stop triggering alternative, enabling that, and then choosing which of the alternatives you like. If you choose no alternative, then the default setting is for your stops to be triggered by the standard setting, or the first price that hits that level. Something else to be aware of on the way through while talking of these things is that if you're trading in reasonably big amounts, up above the level 1 levels, into the level 2, up to 6 levels, where the price at which your order might be filled may actually be a bit behind the best bid or offer price shown on tracker, you should be aware that your price, even though it might be triggered by the level 1 getting there, your price might be filled at a different level, and the sort of calculations that the platform does on your overall profit or loss won't reflect the actual profit or loss at the price where your stop is in fact triggered. Another alternative available as far as stop loss orders are concerned under the order setting preferences is that you can elect to have a stop loss appear on your order ticket by default. And you can do that by enabling this add stop loss by default. All that means is that when you do that, your order ticket will automatically create a stop loss every time you create an entry order, would be that a limit order, a market order, or a stop entry order. And if you choose that alternative, then you can stipulate how far away your stop loss will be on the default setting of the order ticket. You can, for example, choose to have your stop loss appear at the distance of the minimum margin away from current price. So in the case of the Australian dollar, that would be, for example, 0.2%. Or alternatively, if it was a stock, it may be 5%, 10%, or even more according to what the minimum margin was. The other alternative is that you can yourself stipulate a given percentage order for your default stop loss to be away from the current price. For example, 1%, 2%, or whatever you choose. And remember, of course, that if you do use the stop loss default alternative, you can always override it manually on the stop on the order ticket. But this is a facility that can be useful for people who are perhaps new to trading and inclined to forget that they need or that they should put a stop loss on, or for those traders who, like many, have a bit of a problem often with making sure that they're as disciplined as they should be, and this really puts the stop loss alternative in your face and means that when you click the button, the stop loss will be automatically set without you having to think about it. So are trailing stop losses a good idea? Well, again, this is an area where there's no right or wrong, no definite yes or no. Really, the best approach is to think about the kind of strategy you have and whether trailing stop losses are going to be best suited to that strategy. So some of the advantages of trailing stop losses are firstly that they protect profits as trends develop, rather than taking just an A to B approach with a strategy where either your profit objective gets hit or your fixed stop gets hit, one or the other. A trailing stop loss can be useful where in situations where this market starts to run your way and it starts to begin to gradually reduce your loss and protect your profitability as time goes by. They're also very useful for strategies based around achieving a few really big winning trades where your path to success is going to be built mainly around a strong payoff ratio or large average profits compared to average losses. So with these sort of strategies, a lot of traders will choose not to have a profit objective, but simply to rely on a trailing stop loss to take them out of the market. And so when those really big trends develop, a trailing stop loss will allow the position just to run and run and run until eventually it falls back on top of you. The difference, of course, between that and a fixed profit objective is that there will be a number of occasions where you would have made a bigger profit if you'd taken a fixed profit, because there will be some times when the price gets to your profit objective and then falls back down towards you before the trailing stop is triggered. Another big advantage of trailing stop losses can be time management. A lot of clients trade 24-hour-a-day markets, which are a lot of distinct advantages, the big foreign exchange index and commodity markets. But they take time management. It becomes an important consideration. You need to think about what you're going to do when you need to be asleep, when you need to be at work, and so forth. And trailing stop losses can be a great thing there, because you can go away from the market knowing that if the market runs your way, you'll be left in a profitable position for a while, but if it starts coming back towards you, you'll be automatically taken out without having to be glued to the screen. And the same applies also to very fast moving markets where you may not want to be necessarily glued to the screen all the time. You may want to go out and walk the dog or have dinner or whatever, and the trailing stop loss can help accommodate that sort of situation as well. Discipline is a big consideration and a big plus. having that automatic trailing stop loss there takes a lot of the agonising out of the will I get out here or not? Is this looking bad? Gets away a bit from that fear and euphoria problem that bedevils a lot of traders, particularly when they begin, and just puts you in that better space of an automatic result that's going to happen according to your strategy without you needing to override it and make subjective opinions or decisions possibly based on your mood at the time. Not all plain sailing though, and there are trade-offs, and perhaps one of the biggest potential disadvantages of a trailing stop loss is that the stop will often be positioned at a level that's not particularly logical from a charting or technical point of view. This means that there's often a greater chance of being flicked out of an ongoing trend than if you have your stops positioned behind higher probability points, such as behind support and resistance levels, trend lines, moving averages, and that sort of technique. All right, so I'm going to finish off this webinar by looking at a few different strategies for applying trailing stop losses. A beginning point for thinking about trailing stop losses, or a basic strategy, is to think about the number of pips or perhaps a percentage of contract value that is applied to the trail. And here the thought process is that a trader will have observed that for their strategy or the sort of trend that they may be following, that once a market reverses by a certain number of pips, be that 10 or 20 or 50 or 100, or a certain percentage of the contract value, 0.5% or 1% or whatever, then the chances are that a reversal of that amount will lead potentially to a failure of their strategy, the end of a trend they're following, and so they set their trail at that sort of level. So here, for example, there's a little screen grab I took off a chart here where we've seen a trader who might have seen this large engulfing pattern here, big red candle engulfing a smaller green candle on the way up. It's a classic candlestick reversal pattern. So their strategy may have been to sell once this engulfing pattern was completed, with a trailing stop loss of initially of 100 pips, which is what I've got here, based on the assumption that for a day trading and larger, longer term trend following strategy, that if the market reverses by 100 pips, then the chances are that the assumption of a downtrend will be incorrect and that the ongoing uptrend is more likely to be the case. Another approach is simply to say, look, I want to limit my loss to a certain dollar value, $100, $500, $1,000 or whatever, a certain amount per trade. So I will set the initial trail so that if the stop goes off at that first level, then that's the maximum amount I will lose. But if we look at this little engulfing pattern example I had here, you can see what is sometimes a disadvantage with a trailing stop loss. So here we've set the trailing stop loss according to our 100 pip parameter, but when we go out and have a bigger picture look at this chart, what we see is that this engulfing pattern was actually part of what looks as though it might very well turn out to be a triple top pattern, and that the engulfing pattern has happened just very close to this resistance line, and our trailing stop loss now 100 points above that is probably at the worst possible place from a chart pattern point of view. It's right at the resistance, meaning that the price does sneak up a little bit further and then stops it around this resistance, then I'm going to be taken out at that price, which looks like a low percentage price to be taken out of the market. And so that leads to another strategic approach to trailing stops, and that is to make the trail, or the first level of the stop loss, and to put that behind a standard technical failure point. In other words, not to be so concerned initially about how many pips it is, but to place the stop at a level which would clearly mean failure of the strategy if it was to be breached. So here our strategy is to sell on the engulfing pattern at the resistance, And a standard place to put the stop would be well clear of this resistance to allow for the stops to be triggered and a bit of noise to be pushed, to be created by a false break above that level, to place the stop well up above that, so that if it really gets going, then we're saying that it looks like a much better chance that our strategy has failed, and that's where we want to put the stop. Now, that might be 150 pips. And so we can combine that then with positions sizing. So rather than saying we're always going to have a trail that will be, if it set at a level so that my initial stop won't be more than $1,000, we can still say our basic risk management technique is to have an initial stop level of $1,000 and not to risk any more than that, but then to adjust our position size according to how far away the stop is, so that if the stop is very close, at 10 pips, then we would have a much bigger position because we're only losing 10 pips for $1,000. On the other hand, if our stop is 150 pips away from our entry price, then we adjust the position down to make it much smaller so that we still only lose $1,000. Now, the order ticket does this calculation for you, so it's a simple thing to do. And of course, when I talk about this risking $1,000, I need to be very plain all the time to make sure that that assumes no slippage. And of course, I've already canvassed the possibility that stops can be triggered at much worse levels than your initial trigger point, meaning that when that happens, your stop actually might be greater than $1,000. Another thing that's often done or can be used to effect with trailing stops and with the right sort of strategy is to change the trail and to make it tighter once the strategy begins to progress. And a common thing to do there is that when price hits a target level, then the trail is tightened right up. So to look at this situation here with this triple top or potential triple top, let's say this resistance is respected and price comes down and now hits the support at the bottom of the right rectangle. Now we have a possible new failure point, because if price bounces off that, that would look like not a triple top but potentially an ongoing rectangle. So when price, for example, hits this support level, then we might move our trail right in and make it much more aggressive. So down from 100 points now to say 30 or 20 pips low or something like that, to make sure that we get taken out of the market quickly if price does respond to this new potential failure point. A couple of other techniques in a similar vein to have a point on the way to your profit target to change from a fixed to a trailing stop loss. So this is an approach that we quite often canvas in the blog. So here's a strategy that we outlined from memory a couple of months ago in Apple, a big US stock. We observed a potential double bottom, so the strategy involved buying on a breach of the resistance between the two double bottoms and setting a stop entry order to do that with an initial stop loss down behind support back in the body of the triangle. Now that stop loss initially is a fixed one, not a trailing one, it's just set at that level. But this strategy said that set a profit target based on the measuring rule, where it took the height of the double bottom pattern and added that to the top of the double bottom using the Fibonacci tool, and the 100% measure up here is now what's called the measuring target, which takes that pattern height and adds it onto the breakout point. But one approach to that is to say, is to play around and find out what common failure points are. Often these sort of pattern strategies, the 61.8% measure on the way up to the strategy can be potentially a failure point. So this strategy called for changing from a fixed to a trailing stop loss if price got to or extremely close to this Fibonacci or 61.8% failure point. So the entry here was at 407, and on that basis the trail was snigged right up when this candle nearly made the 61.8 to a trailing stop, which got triggered at around $503. Then finally, or not so much finally, then what can be done is one of two things. with a pattern trade like this, a trader might say, well, look, if price backs off here and does fall away as it did here and make another retest, then I'll have a level at which I might buy back in. And in this case, if you're looking at the overlap technique, once this trend got up and moved past previous support, which is now new resistance, that may have been a trigger to re-enter the position. On the other hand, if the trailing stop failed and you got stopped out, or it didn't do the job, you did get stopped out by it, but then price went on to quickly move away again, a trader may re-enter once that 61.8% is taken out. So what they've effectively done is taken themselves out of the market briefly, looking to defend their position, but with a view to getting back in and not losing too much of the trade on that sort of basis. And lastly, another thing to canvas and a commonly used technique for trailing stops is not to have a profit objective at all. And so rather than actually placing a limit sell order at this target, the trader's strategy will be just to keep on trailing the stop past this level. And that can be either done with an automatic trailing stop, or another technique, for example, is to use a fixed stop, so that once price gets past here, you manually just move a fixed price stop price up to this level and leave it there, so then you're no worse off than had you taken profit at that level, but you allow then profit to potentially run up to your next target level and so forth. So as you can see, there are all sorts of ways of mixing and matching trailing stop loss strategies and fixed stop loss strategies with trailing stop loss strategies, and often the key to overall trading success, or the key to success of a strategy, is to develop rules for how best to use those techniques and what your actual best way of handling a given idea in terms of your entry and exit strategies actually is. So that concludes this presentation, ladies and gentlemen. Now, just a reminder that we have a blog here at CMC Markets. You can access it via blog.cmcmarkets.com.au. And one of the things we do here is to put up discussion points on the sort of strategies we've looked at here and canvass different ways of going about placing entry and exit levels, using stop losses and so forth, to try and promote discussion, give traders both new and experienced different ideas and different ways of looking at things. So thanks very much for listening in.